Today's topic is going to be what happens if you miss your entry. So you're watching a particular time frame, you get a green light that it's good for you to take a trade, and just either you sit still, you freeze up, you second guess it, or you turn the charts on late, or you didn't notice it and then it's now after the fact. So how do you work with that? If you look at the 5-minute chart, I like that sell side because we opened up with a premium gap, opening range gap higher than previous day's settlement. It's most likely a 70% chance that in 30 minutes before 10 o'clock, it trades to mid gap. We're looking for this price down here. It's also a pool of liquidity resting on this little base of price action. So first presentation, fair value gap is here. And we're going to work primarily off of the 1 and 15-second chart today. Now we're trading into first presented fair value gap. I really want to work inside of the 10 o'clock hour for silver bullet. Like I want to use that information during that hour. I'll wait till 9:50, 10:10 macro. Purposely sitting still. If the trade sets up, I'm going to let it go, and then I'm going to try to use the logic I'm trying to convey to all of you willing to listen is how to get into a move that's already happened. Here we have this candlestick's high, 19,793 and a half. We have yet to trade to number 3 candle's high, which is 19,795 even. So we have to trade to 794.75. We have not traded there yet. So settlement, previous settlement, opening price. Here's your opening range gap, and then we'll grade it real quick. Upper quadrant we've already traded to. That's this right here. My advice is that if he's going to trade the day before FOMC, he needs to do it in the morning session. I'd like to see this jump up into that fair value gap there. So what I was looking for is a run, because we had this low and then this low here, trading down into the upper quadrant of the opening range gap, first presented fair value gap. And I was explaining it off of the basis of this low falling short of the upper quadrant level of the opening range gap. And then it trades down to that, sweeps that low, but it trades to the upper quadrant level. And then we created this little tiny little fair value gap. You see that? For fair value gap trading, you can do high frequency trading, and the only thing you're doing is looking for relative equal highs on a 5 or 1 minute chart. Once you map them out in close proximity to where we're at right now. So what would that look like? Well, you would have, so that would be like a high frequency run to short term, either 5 or 1 minute buy side or sell side liquidity using no bias, just looking for a price run that takes out short term highs, short term lows. So that's what I was saying about wanting to waiting for a little bit more time-based delivery. If you're expecting this just to go up there and fill, like getting in that entry price there, you would have to endure this. When you know what you're doing and you understand the characteristics, you know what is going to happen. You know the likelihood that a fair value gap, a PD array, it might work through them. And that's not failure. It just means that it's going to color outside the lines and get a little animated. And you can see that happening here. Sell side here. So now what I'm doing is I'm watching the this wick here. I'm looking at the 765.25 level because we traded up into first presented fair value gap. This is the mid gap level. So mid gap's here. There's the delivery to mid gap. So 70% strike rate, true today. And now we have the lower quadrant level here at 694.5. That'll be our next downside objective. Okay, so we worked lower, got close to lower quadrant, left a small little gap here on the 15-second chart, and then now we're back in the high of new week opening gap. We have a short-term high here with a SIBI, sell side imbalance, buy side inefficiency. So far, the first presented fair value gap here is obviously this candle here. That's candlestick number 2. You're watching this price up the high. To use my entry technique, it would have been shorting as it slammed into 19,794.75. You may elect to trade a sell limit order. That would be at that price, 795 or higher. You could try to get the consequent encouragement, but it might not go there. You can try to get the lower quadrant. That's probably a good price to reach for. Or if you're really, really greedy, you can go in there and try to get the upper portion of this gap. You can see we just created a mohawk. So you can anticipate when the market will color outside the PD arrays. That's part of what you're doing. You're watching how it interprets that. How does it deliver around it? I will allow the market to throw a curveball, and my PD arrays will get colored outside the lines. The mohawk going above that fair value gap, ideally it stays inside of it. And many times when we don't have these environments, which is the day before FOMC, that means it can be a little bit more careless in terms of its precision. So you won't see really crisp delivery of price action. So if that's what is likely to occur, why would you want to use your lowest entry threshold? Watch and see how it trades up into the fair value gap and be more selective. And in my opinion, allow it to first run to the extreme of it because it might want to do that. And then once it creates the mohawk, you can trade inside that wick that created that, and you'll get really good premium pricing and then trade down to the mid gap, because in the first 30 minutes, that's your bias. You have to go and pull up a fib and drop it over the opening price of today at 9:30, anchored to yesterday's settlement price on regular trading hours. And then the midpoint on the fib, that is your 70% bias for the first 30 minutes. We gap open higher. Is it more than 40 handles? Okay, then you have a respectable opening gap. That means you can anticipate the market creating a 70% strike rate of returning back to the half gap. So your stop would be above this candlestick here. So anything you're shorting in here, your stop's above this candle. So yeah, we wicked above the fair value gap, but that doesn't do anything to upset the trade. So if you know that it's going to be a day that has characteristics that allows and affords the market to be a little bit more muddier, where it colors outside the lines. How do we know that? Because tomorrow's FOMC, and the morning or day before can tend to be a little bit more reckless, more wild. The price can be a little bit more disorganized. Shorting in this first fair value gap, the gap itself formed at 9:33 a.m. Candle number 2 is where your stop is going to go. I will use the Dow for a SMT divergence, early warning, but it's not the deciding factor. I'd prefer to see a SMT divergence between ES and NASDAQ. Do you see the SMT divergence? These highs here, this high went higher than that one, didn't it? Now look at it here with the NASDAQ. By comparison, this looks a whole lot more animated, doesn't it? And when there's wicks, I'm looking at the bodies because that's where the bulk of the volume is. So there'll be times where you'll see that the wicks might be higher, but the bodies aren't. Inside this swing, compare that to here. So NASDAQ went higher, both in wicks comparatively between this highs and here. And in ES, you see what's happened here? Here's the high, and the wick went higher, but what do wicks do? What did I teach you? They do the damage. So this is an SMT divergence because the bodies in the high here are lower than this. So by comparison, again, you want to use the time frame right above the executable time frame and the time frame that you intend to trade on. Now, I like the 19,926 level. That's the equivalent of the September contract. You can check that out. Look at your hourly chart on the NQU2024 and then look at the August 27th through 29th highs. There are like 4 or 5 of them up there. Real smooth. The equivalent for the December contract, which is what we're watching price in right now, that is the same thing here. That's where those relative equal highs are. That's that big pocket of buy side liquidity. If we don't go there today, I think that FOMC tomorrow will target that area. Gray pools, which is a PD array. It's how you use wicks. Wicks are a PD array that you can look inside of them in that little gray area. I'm looking for clustering of wicks because nobody's paying attention to them. The idea of moving from 1 minute buy side and sell side and then using a 15-second chart, you can find very, very high frequency trading setups in that. You're going to get stopped out more times than anything else I've taught because you're going to be chasing every potential run into liquidity on a very small time frame. And the times you're going to get caught offside is when you don't refer to the time of day, the day of week, the week of the month, the seasonal tendency, where the higher time frame daily order flow and weekly order flow is reaching for. Specifically this. I believe this is where we're going to aim. Now, because that is a likelihood, and we have big news coming out tomorrow, I would not want to swing trade today. I think it's more reasonable to see them leave this here. So while there is a approach to trading high frequency using sub 1 minute time frames, you can get 20, 30 trades a day easily. And that wouldn't be over trading using that model. So what happens if you know that this is the likely draw? If you filter out all the high frequency trading that you do sub 1 minute, aiming for short-term 1 minute or 5 minute buy side using a 15-second fair value gap entry model, you're filtering out all the potential for you to get nailed if they do in fact want to run up there and hit that. You're looking for a gap of 40 handles or more. The larger above 40 handles, the better. That's over 100 handles. So you are in a jackpot. Like you have an easy 70% chance that in the first 30 minutes, you have an ability to sit down, know exactly what you're expecting to see in price, down to that gap's midpoint, which is 728.25. So you have essentially 50-ish handles. Large opening gap higher, wonderful. Find the mid gap, find your opening price. That's your range. That's the profit potential, okay? So now what do? You wait. In 1 minute from the opening price, you can take your time. You got 60 seconds to say, okay, what's the math on this? Here's my opening price, and then the mid gap price is down here. Once you anchor your fib to the opening price, that's your price you're aiming for. That's your range between this price and that one. So you know your bias is what? You're gonna try to go short. So now what do you wait for? You just go and go short? No, you watch price. You wait for it to do what? Create the first presented fair value gap. This is the first fair value gap, this candle here at 933. So it meets the criteria. It can't be on the 930 candle. 931 is the earliest candlestick that can create the fair value gap, candlestick number 2, that one that makes the imbalance. This is candlestick number 1. This is candlestick number 2. And here's candlestick number 3. So candlestick number 3, your entry is either one tick below if you're aggressive like me. I trust this model. I could be selling short there, and any opportunity it's inside that gap here, I'm going to short. I will short right at that mohawk because the stop's up here above this candle's high. The number 2 candle, anywhere in here, go short, stop up here. And this is such a good model. It answers everything. When it starts to break down, you find a short-term low. Once it breaks that, you put your stop loss to cover costs. If you have more than one contract, you take a partial below the short-term low. Everything I'm saying here, when we have a gap lower opening, more than 40 handles, 50% of the gap is your target. Wait for the first presented fair value gap, and you're going to be using it as a means to go long and trade up to the half of the gap. Here, first fair value gap here is your entry mechanism to get down to mid gap. And you have a 70% strike rate built in. You've got a home field advantage that this is going to happen 70% of the time. Now, you can further increase that strike rate by understanding the economic calendar and understanding the likelihood of what happens if you take 75 to 80% off of the trade at the mid gap and you don't have the experience and you want to see if it can go down to close the entire gap. Okay, just put your stop loss somewhere above the short-term low you took profit at or partial. And if it stops you out on the bounce, who cares? At least you had a free look. You did 80% off here remaining from the position after you've taken off a partial. Or don't do any partials. Just expect that it goes below this low and accelerates to mid gap. Look at the bodies. Look how the bodies are respecting that mid gap level. That's algorithmic. It's doing something that it's been scripted and coded to do. Premium pricing, that means the front month is more expensive than the distant month. For instance, right now the nearby contract is September still, and it's going to expire. And then it becomes the December contract. That's your nearby contract. Then you have the next month out, which would be March 2025. In a carrying charge market where the normal pricing model is in play, you will have higher prices for, like if we're looking at corn or soybeans, usually it's more expensive. The price right now for this contract in December is trading at $19,797. Now contrast that with NQ, we're in the 500s. So there's a premium in the December contract versus the price that's in September. You see that? Well, that's a normal carrying charge market, and it's more useful in a real supply and demand market like grains, cattle, something that we eat or consume, oil. Okay, there's a real buying and selling demand in these markets because they're like they're the resources that makes the world go around. We don't really need to buy the S&P and the NASDAQ, just like we don't need to buy shares of stock. So while it's better for the market if you're bullish to see the nearby contract trading for more money than the next month's out in the future, the price should go higher in the future when you're looking at commodity prices. But if that ever reverses and it's higher prices right now, then you have an inversion from a carrying charge market to a commercial bull market. That means large conglomerates and commercial users are more interested in buying it so much that it can maintain a huge premium in price relative to the traded price of the distant month contracts. It's a very simple thing. If you go into the commodity teachings that I have in the 2027 mentorship, I believe it's month 10, you have no excuse not to be finding consistent setups every single day. You have an experiment laboratory for 30 minutes every single day. Caveat now, here's the spin on that logic. As long as price remains below your stop loss when you're short using this model, and we have not traded to the mid gap, you stay with the trade until you're either stopped out or you get your target. Okay, here's how you're gonna mess it up. You're going to over leverage. You're going to try to trade before the fair value gap is traded to. You will not take the trade because you haven't watched it enough times for weeks and months to desensitize yourself to it, to trust the data. Because once you see it, you can't unsee it. You just take the trade based on the parameters. And that means trade with one contract, the smallest contract, the micro. And you desensitize yourself to the importance of the money. Give me at least 1 month where you're doing this every single day. So that way you have a whole month of data. And then see what you were recording about what you felt when you were doing it. Watching it, observing it. Did you get emotional about how you were feeling you're going to be right and conquering? Were you fearful that it wasn't going to work? You have to get that baseline measurement about you, because the you is what's going to mess it up, okay? And this is one of my first automated things. If these parameters are there has to be 40 handles from previous settlement price to where we open first or more. It's better if it's larger. If it's over 200 handles, I've seen in the last 2 years or so, I will defer trading this setup because chances are it might still keep running because something else, there's heavy manipulation going on. Minimum 40 handles, 100 handles approximately. That's your sweet spot. And if you use this mechanism, you know where the stop goes. Above candlestick number 2 if you're short. When you're bullish, it goes below candlestick number 2's low. You know what to do if it doesn't trade to the target yet. You hold it or let it get stopped out and be comfortable with it getting stopped out because you should have a partial taken. If you're trading with one contract, allow that stop out to happen. Record what you felt as a result of that. You're going to go to, I wish I would have closed the trade at this point where it was the maximum. And if you do that, what you're saying is you want to be right and you have to work on that. That's what you're supposed to be doing when you're tape reading. You're discovering yourself. And when you demo trade, you're trying to discover where your bad habits are. You can see, look at the characteristic of this market right now. It's just ranging. And that's classic the day before FOMC. All right, so see what they did here? We have these lows. This is jagged on the bottom end. What's up here? Short-term buy side. So, all right, over here we have 15-second chart. I would not be terribly excited about this afternoon. All right, so hopefully you can get a little bit more displacement here on that candle and give us a fair value gap. If it runs right to 1850, then we have to wait. Got to give the gap on the 15-second. But you're doing these drills as many times as you can. If you can only do like 1 or 2 a day, that's fine. It's too close to the liquidity. Just be comforted that we can see these liquidity pools and see how easy it is right to it. And that's just one instance where it'll do these. That right there is something that you should log. It didn't give you the setup, like running into those I mentioned earlier. But sometimes they'll run without it, and the fair value gap is not given to you. So let me go back to this real quick. We had these lows here, and this was made jagged. So sell stops down here on the 1-minute chart were taken. Remember I was telling you earlier, if you're going to be doing these exercises, be aware you may not know how to do this because you're learning, but figure out where the higher time frame draw is. What I showed you earlier up here at 926 level. I mentioned beginning of stream these up here. These are all potential draws because of this being the higher time frame reason for markets to want to go up there. There's those relative equal highs that we were watching in the September contract. That is the same level here just for the December contract. So the prices are different, but the same school of thought or reason to expect to trade there is still the same here because it's still relative equal highs on the December contract. Is if you go back and look at the last week of August of 2024 in the December contract, it's a lot of gappy price action, but doesn't change the fact that it's too smooth. We're most likely going to see it trade up in here. I'm not saying you need to do it today, but as a higher time frame draw, if you're going to be doing these little exercises, get yourself desensitized to getting into trades, get yourself some experience pushing the button, managing a stop loss, managing how you're going to endure getting it wrong if you're getting it stopped out, if it runs in your favor. It gives you all these perfect little laboratory conditions where you're not influenced by the money. You're doing one contract. You're not trying to pyramid. You're not trying to be perfect with your entry. You're just getting some kind of exposure in price action. Well, if we know that this is likely the draw here on the daily chart, it's better for you to filter only going long if you're going to be using it to take trades with monetization at the end of it. But don't think that way while you're doing a baseline evaluation, because you want to see what it's like when you do it wrong. Or if you get into a trade and it runs aggressively the other way and doesn't go to your target. You need to identify how you're going to respond to that. You need to know that as soon as you can, because it's going to highlight what your character flaws are. And don't hide from it. Right now, we're looking at how prices respecting that September 1st new week opening gap. There's an overlap of this low. I'm watching the bodies here on the 1-minute chart. So we don't have any buy side to refer to here on the 1-minute chart. So we got to go up one time frame. There's those relative equal highs on the 60-minute chart for December delivery, the contract. All right, so we have this high right here. You see that? It's moving still closer to the 19,926 level. So now that level, so there's another pool of liquidity buy side, and it's framed on the hourly chart. Now I would like to see this stay open because we already dropped into it here. Open, if it started to displace higher, then that could have created a fair value gap. So new week opening gap on September 1st, just about near its high there. All I just did was annotate the minor buy side and sell side. How do I know that there's buy side? Because the market turned here and went lower. We created a swing low here, and this candlestick right there, as soon as it closed, that validated this as a swing low, and then the buy side would be here. That candlestick right there, when it hit that, that was the entry for buy side. And then I would want to see inversion in here, where it spent time, a lot of time back and forth in this range. So 19,813. 50 is also September's 13th daily high. I'm not impressed with the run below the short-term low just to get to that level. I don't see it like it's breaking down to keep going lower. It's going to have to prove something significant to me. On the downside, I'm more inclined to fish on the upside. It can drop and it's fine. You have to have rules, and the rules here are I'm not trying to be short. We've already shown a willingness to gravitate towards that 19,862.75 level, and that's not even close to the relative equal highs at the 926 level. Breaker, low, high, lower, low, this candle's range, and we have that little inefficiency there. That's where we're in. We're inside of that right now, so I'm watching it. So we're inside of September 13th old daily high, but here's a breaker. That would look like this. Now, if we lose this range to the downside, then we may have done enough for the morning session going into the lunch macro, where they'll move against the traders that have been long. That would be this sell side resting right here on the left-hand side chart, but it has to leave this blue shaded area. If the breaker wasn't there, this would be the short. Now, buy side goes to here. And new week opening gap, if it's going to go below here, it's reasonable to see it try to reach into that as well. What time is it? 10:50, 11:10 macro. Sell side That little gap right there, that's the one. But I wanted to see it come down and give me one tiny little gap below that. That was the one I was wanting to aim on. All right, so day low here. I'm not convinced that they're going to come down that far, but I'm willing to give it another opportunity to sweep below here once more. So this low now becomes sell side. So any little rally in here, as long as I don't go to the mean threshold of the breaker, that's this range here on the 1 minute chart. Then it could be just setting up a retracement here, just dive one more time and get into new week opening gap low. Then if I can get a rally after that, I'll work with any fair value gap there to trade back up to the breaker if it can afford me 20 handles range. That's the filter. It's got to give me at least 20 handles of where I try to get in at and where I'm trying to aim for. If I can't frame that, then I have to sit still. Now, because we're below this breaker, low, high, lower low, then rallied to new week opening gaps, broke down, went below the breaker here. So as long as we're below half of this range, I wouldn't be interested in anything long. So what I'm saying is I'm looking for some reason for the market to fail to get above the midpoint. It can trade where it's at here. That's normal. It can trade right up to it. But the gaps, the PD arrays, they all have an inverted aspect to them. It's very specific prices. The low, the lower quadrant, and the halfway or mean threshold, because it's an order block. Half of this breaker to its low, that's like the area where the turn could happen, and a run below this low down the end walk. That would be a setup. We have a gap here. I want to put a short on so that way you can see trading against a higher time frame likely bias on a day prior to FOMC. Late in the morning session, I see it wanting to take this short-term high here first. See how much time it's staying inside that gap here. You don't want to see that. But using that one, you would have been stopped out, or I would have been stopped out there. How did I know that? Well, it's because I think that this was too easy, too shallow. And I think that either they're going to send it higher or they're going to take it right above this high anyway before it goes below these relative equal lows. I can justify both sides. And if I can do that, it's not high probability. So it's giving me the ability to show you that just because it looks like it's a fair value gap, where we're at, what time we're at, and how it just delivered that little tiny wick into the lower half of that break. I feel like we've pushed it up a little bit from 930's high. We went lower, consolidated, made all of this in here jagged, and once more here after trading into the new week opening gaps above the initial high of the day. Because we've had 1, 2, 3, 4 lows produced to the downside, this is really, really jagged. And I would be trying to sell short in the very low end of the range. So what would I be doing? Selling here. I'm selling a discount. There's people out there want to buy something cheap. So I'm watching this high here, because that'll tell me what I want to do. It's just slowly gyrating up to that little high right there. So you have to sit still sometimes. And if you don't know what you're looking for, it could be frustrating and drive you nuts. So now we have somewhat of a balanced price range in here. I mean, it's on the 15-second chart. I don't want to make too much of that. This little gap here, we're seeing these little tiny candlesticks reaching up. I would like to see it just go above this high here and then come back down into this inefficiency and see if it can support it inversion characteristic. Just bumped the low of that breaker block. I don't want to see it hit the bottom of the breaker block and come down in here. I want to see it take this high, come down, hit that, and then if it shows displacement higher off of that, then to me it's a little bit more trustworthy to the upside. And then I can entertain maybe a run into the high of the breaker or this inefficiency right there. Now take a screenshot of what we're looking at here. This is exactly where you can identify where you do not want to trade. I want you to see the difficulties of it. Look at how it's behaving. Is it animated to try to get anywhere in a quick, fast, sudden manner? No, it's just like, I'm just moving around lethargically. Either side of the marketplace, it should have dropped here if this was a valid fair value gap, which I told you because of all the things that are on the 1 minute chart, it doesn't bode well for selling short that low in the daily range after it's already had this big drop down. So this lunch macro where it took the sell side out, that right there might be the low, and we could be higher in the afternoon. That's what I wanted right there. Now, because this inefficiency is the only one that has any interest to me at all, I want to see, do they dive it back down into this? And then if it can hit this, but not go through it with a body, if it can hit it and displace higher, like a big, nice series of 1 or 2 candles to the upside, create an inefficiency there, then that could be a catalyst to get us up into that inefficiency there. But I asked you to take a screenshot because the way prices just meandering around, that is what happens when the market enters a buy program, where it just starts ticking higher. It's just going to keep offering higher prices. It starts squeezing and squeezing. And then as it gets to a level where there is an inefficiency or liquidity, and on the 1 minute chart, you see it right here. That's that short-term high. These are very, very challenging conditions when it's behaving this way. So there's your buy side. All right, so now we're back above the mean threshold of that breaker. It's this candlestick right there. It's the last up close candle right before the drop down to a lower low there. So it's a low, high, lower low. It did not come down to hit this area here. It just kept booking price higher, 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 higher. So they're going to make a mad dash up to attack these buy stops. So we're back at September 13th's daily high, top of the breaker. Now, because we have this area of inefficiency, now mind you, it's anchored on a 30-second chart. So bear that in mind. It's not like it's on an hourly chart where if this were an inefficiency in this time frame were a 1 hour chart or 60-minute chart, price would have no problem going up with one single candle into this little area. It can still do it on the 15-second chart. That's still a characteristic because it's only in a 15-second chart that it has this inefficiency there. Because if you look at it over here, it's been offered buy side delivery and then this single candle on the 1 minute chart. Inside that 1 minute chart's range, we have this small little inefficiency there. Keeping to the rules, I still would like to see it ram up in there pretty quick. And if it's going to get in there, why not just take out the liquidity right there? Working towards the low end of that breaker, spiking through mean threshold, which is the midpoint. Whenever there's an order block, half of that range is always mean threshold. If it's a gap or a wick, the midpoint is consequent encroachment. All right, so we're at mean threshold, half of the breaker, and we have the inefficiency right there. And I'd like to see that be used as inversion. You want to see it go away from a little bit and come back down into it and then run up into that inefficiency right there. Now look at the delivery of price here on the 1 minute chart. Watch how when it goes higher, you see any gaps. This was immediate rebalance. Really. Small little volume imbalance there, but no fair value gap. And delivered to the high of the breaker. When you start seeing price doing this, that is the algorithm in a buy program. That means it's simply going to keep offering higher prices. That was the reason why I stopped. It's better for me to illustrate why that's not even a good one. So the screenshot of you seeing how price is not giving you any kind of fair value gap. It's just one steady, just booking higher, and no inefficiency. So if you're offside in that, it's very, very painful. Notice the bodies, we never left it and came back down. The bodies are staying inside of it. Is that displacement to the offside? No. I want to see this small little portion stay open. And now because we had this nice little retracement up in here, I'll explore to the downside. I want to see if we can get to the consequent encroachment of this gap. No, stay inside there. All right, wait, I'll wait for it again. I believe it's going below this low. So we had this nice deep retracement, pressed higher to the top of the breaker. We couldn't find inversion there. All the bodies stayed inside of it. Nice displacement to the downside. We rallied back up, meaning that I don't want to see it trade back to the bottom of that blue box or into that volume imbalance. I'd like to see that stuff stay there. And if we can find ourselves heavy in this area, that should allow for a run to get to the sell side. We still have to wait for the fair value gap that makes sense, and it's got to still work out the creases. So knowing how you can fail, knowing how you can lose money, identifying it and saying, no, this isn't it. That's going to come with experience. It's not a matter of going out there and try to trade everything and make money. The main thing is capital preservation. See, I don't want that. Ideally, it should have went to consequent encroachment of that gap right there because it's matching basically this one. Single candle up, single candle down. They're sharing the same range between their highs and lows that make this imbalances. So that's a balanced price range. So I want to see it trade down below it and show a willingness to hit half of that and then drop. Then that drop would be candlestick number 2 of a fair value gap that I could use to get in to get short and then run down here. But since it's not doing that, I have to sit still. Now we got the volume imbalance redelivered too. Could roll over here lower, but it needs to show a displacement sharply down to the downside. I want something at mid-range of this gap down here. Even though this is a higher price, if it's going to drop, this would be a better entry because it's a higher premium price. I don't trust that my entry there would be sound. Watch that wick right here. To force myself into taking a short to this low. Yeah, I don't want to see it support price there. I like to see it lay down candlestick, but not close outside the low of it and create a inefficiency so I can position inside of that. Volume imbalance. Delivered to that. Now this right here, just deliver it, man. Good grief. There you go. Now don't run away. Don't run away. Don't run away. Don't run away yet. I want to see if we can touch the bottom of that inversion fair value gap. Volume imbalance right there and the low. Oh, you fucking kidding me? Okay, well the stop loss would have to be above this candlestick's consequent encroachment of the wick. Okay, so it would be 1 tick above that, and the limit order would be at that price. Okay, 745.25. It's this fair value gap there. This is the gap. That's how I was eyeballing. You can take a partial there. So you would be in with a stop that covers the costs, and you'd be in 1 partial already. Has some relative equal lows there. That would be a partial. So now you'd have 2 partials booked. The stop would stay right where it's at. You stick with it and aim for this low right here. Stop would roll to here, and you'd stop out on the balance there. And you do all your markups, get all your information from where you were entering, what was the total drawdown, and you take your partials. Where I was queuing up audibly, you would take a partial, and then the partial here, and we rolled the stop down, because once we have a partial, a second one, and we're getting close to the low we're looking for, this low here and the rejection block is what I was looking at, and that's why I said to drop the stop to here, because what we're doing is what I taught you in this mentorship, where if you don't know how to time or select the partials to get out of the trade with pieces of it and profit by chasing down a recent high, just let the market take you out. It removes all the worry about which one should I do or how should I manage it. You got two partials, you let the market take you out, and it doesn't have to go down and take this low out. It's just the target. So not an easy session. It's not impossible. Obviously, you can see what we were looking for and framing it where it makes sense. It has to make sense. Just because price is moving around doesn't mean I have to be in there. Doesn't mean you have to be in there. But finding a setup, getting in, and getting 20 handles. That's a nice little bread and butter type setup. The main takeaway today is identifying how price was delivering all this run up to the top of the breaker. All of this is all one-sided. All of this on the 1 minute chart. That makes it hard to find an inefficiency in. You have to just let it go, and then it'll do this. Give up the ghost space. Boom, you'll see an energetic run. And then here, big energetic run. I wanted to see this stay open, because if this is the low I'm aiming for here, if this would have stayed open, this would have been a whole lot faster and quicker. It still very well may go down there, but it would have been a lot less of this kind of stuff. And I would have been less inclined to tell you where the stop would have been dropped down to here. That would have stayed at where it was initially. Once it covered costs, it would have stayed there, and then the run below this and into new week opening gap down here. Teaching how to wait for a setup, being very critical of the framework, the things that I would like to look for,